I'm Chuck Whitman, and I build great traders that lead great lives. On Wednesday, we went over the market activity and market action around the FOMC meeting. Now, yesterday, Thursday, the market gapped higher. And in fact, what it did is actually rallied all through the night in SPY and in Qs and in all of the indexes, basically. One of the things I do is I look at the day-only action because that's when the majority of the participants, the big market participants, they're doing their thing during the day session. And I mentioned this idea of how I think the Fed actually manipulates stock index futures. I think they do a lot of the manipulation at night when the market's a lot thinner and the arbitrages don't necessarily exist. So yesterday, the market gapped higher, and in S&Ps and in the Dow, it gapped to all-time highs. It put in a very strong day. The chart that we were looking at on Wednesday. This was the 5-minute range after the FOMC announcement. So we boxed off the high and the low, and we considered this to be the range to focus on. And if we broke out down, then we would consider that the market could be reverting. And if it broke out up, then we would be looking for a new trend to emerge. So as you recall in SPY, this ended up being unresolved basically into the close. It was trying to break out down on the bottom by the close, but it was definitely not convincing that was the case. This is actually what happened after. You can see here is that box that I just showed you that I drew and extended all the way across to now. And you can see here's what I was saying. The market was trying to break out down, but was not really able to do it. And then it rallied all through the night. And then basically here was the open in the day session. You can see the market kind of went sideways, but it was up significantly from where it had closed in the prior day. And there was good volume flows yesterday, and this put at all-time highs. So with what happened yesterday, we are really looking at that this market is a market that is going to go higher. This 50 basis point cut that we talked about, it is a stimulative cut. The general consensus is that we are in a soft landing. What that means is that the Federal Reserve, they cut rates significantly, cutting them 0.5 percentage point or 50 basis points. Usually they do this when the economy's in trouble. But right now the economy is not showing signs of being in trouble. The economy is stable, which had a lot of people questioning why would they lower it this much. So we go into a soft landing scenario like this. It usually plays out one of two ways. Either one, which actually happens quite often, they do the interest rate cut and then the economy goes into recession. Different than what people think. Now, like I said, usually the economy's already falling apart. And remember, a recession is actually a lagging indicator. A recession is 2 consecutive negative quarters of GDP growth. So it takes 6 months. So usually by the time you get the official recession signal, you've already known you've been in a recession for some time. But one of the scenarios off this rate cut is that we actually go into a recession. And one of the ways we know that is by watching the long bond, the 30-year Treasury bond. You could also watch the 10-year Treasury note. So let's actually look at the 30-year Treasury bond for a minute, and you can see in here what I'm talking about. This is going to give us a good judge of what's going on. You can see that the 30-year Treasury bond has been selling off. And when I talked about this range that was out there from the number, right here was that 5-minute window. Well, we can see that the 30-year is significantly below. I'm just going to draw the line to the low, that 5-minute window we looked at. There it is right there. You can see we broke through it and we're significantly below it. This would say that the economy is going to be strong and that inflation would be an issue. So the first scenario is they do the rate cut and we fall into recession. If that was the case, we'd expect to see this long bond rally and interest rates to go down, kind of in a flight to safety type of thing. The second scenario is in the soft landing is that we actually get into a melt up. We get into a parabolic move where stocks explode, gold explodes, and this typically tends to be the last stage of a bull market. It tends to be the blow off of the bull market. So in this case, the long bond would go down because the market would be inflationary. One of the scenarios we've been looking at is that we thought because inflation was so strong, we thought there could be a scenario where the Fed cut prematurely and too aggressively, and then inflation blew up again, and they had to scramble. Well, if that is the case, if that scenario happens, we would see the long bond go down in price because interest rates on the long end of the curve would go up. This is actually what we're seeing. So then, as I said, when we looked at this chart here of SPY, we can see that SPY's been working higher. It is lower today. but notice it's retraced to essentially the top of that box. So we're going to watch this. Something else that's very interesting is, so SPY and Dow made new all-time highs. NASDAQ and Russell did not. NASDAQ is close though, and NASDAQ has been really, really weak, relatively speaking. But one interesting thing since the announcement is that the NASDAQ has actually been stronger. So this is the chart we just saw, and we can see that the market is trading back to the high of that 5-minute window, right? It's actually trying to bottom in here right now, actually. It's very interesting. This could be the low of the day. This is actually very strong support right here that we'd be watching for this to be the low of the day. Okay, so now let's look at NASDAQ. Well, look at that line. I'm going to draw it again so you can see it. Look at that high, that 5-minute period. And I want you to notice that where NASDAQ is right now, it's nowhere near that line. What that's telling us is that from a relative strength perspective, NASDAQ is acting stronger than SPY. Now, it hasn't made all-time highs yet, like SPY has. But this is a sign that NASDAQ is actually starting to act stronger. So we want to keep an eye on this. Now, I do want to show you the Russell, because one of the key elements of the market being able to rally and the economy being strong is we should see the Russell be strong. And again, if we look at that 5-minute window, there's the line of that 1 to 105 window from the FOMC announcement. And I want you to notice the Russell is below it. It's still inside that window. It's below that high. It's still inside that 5 to 10 minute window. So Russell is really underperforming. Let's go look at Dow, just so that way we'll have looked at all four. Let's look at the future. And Dow is also inside, which is very interesting. So to summarize, we have a bullish outlook on stocks. Based off what we saw yesterday, breaking out of this range, we think stocks are going higher. We think the indexes are going higher. But this is not a raging bullish signal. If there was a raging bullish signal, we would see all four indexes, S&Ps, NASDAQ, Dow, and Russell, all above that range from the FOMC announcement. And we would see all of them marching higher. We'd see all of them making all-time highs. Right now, only 2 are making all-time highs, and only 2 of them have broken out from their range from FOMC. That's not plural strength. So we're bullish, but I would qualify it as cautiously bullish. We're going to continue to watch the 30-year bond to see what the 30-year bond does. And as long as the 30-year bond is selling off or staying lower, we're going to be thinking that the more inflationary scenario is in play. One last thing we want to do, we're going to look at gold. And with gold is also above that window. It tried to break out up, and then it actually broke out down and finished very badly on Wednesday. This is a classic example because sometimes, like you can really see it here on this chart. If I look at gold futures, and I think we'd see it better in GLD. Let's look at GLD. There it is. GLD had a high volume outside bar down on Wednesday. This is a lot of times considered to be really bearish. But this is a great point. Whenever you see a really bearish bar, it needs to follow through. So this alone, this might get you somewhat short, but if you're really looking for confirmation, you need to aggressively trade below this low, which we don't do. In fact, we go back up the other way, and now we've gapped up to all-time highs, which is really bullish. Remember, if I went back and you looked at what I said I was the most bullish on gold. So I was a little bit frustrating that I did this on Wednesday, but that's life. That's life. It did not follow through. Now we're making all-time highs. And if we think we're in an inflationary environment with the long bond selling off, we should see gold launch. And look what it's doing. The last week, it's really been taken off. It's doing a decent volume. There's some good volume days in here. And then we got today. Today's a big day. Let's see what happens. So hopefully this helps you frame not only what happened in FOMC, but get you thinking about what you should be looking at with your trades related to the macro environment right now. Cautiously bullish stocks, really bullish gold, keeping an eye on the 30-year bond to see if it continues to sell off and go from there. Hope this is helpful. Please like this video. Please share this video, and we will see you soon.